Yes, we're live here. So, good evening, Ashish.
Good evening.
It's great to have you here, and for all the audience here, a very good evening. I think this is a great interaction which I'm having after a long time. I think first of all, thanks to you for taking the time off your off business to be here and kind of sharing your thoughts and your journey and your experiences. But amazing to just be here with you. Just to start off, I know just for the audiences, right? If you look at the SMEs within India, I've always been really intrigued and excited with the kind of fragmented space and the kind of business models that exist within the SME space. Um, just for all of us, I think there's like around 64 million units in India, a significant segment of the business landscape. They employ a lot of people, 450 million people kind of stuff. They contribute a lot to the GDP in terms of, how they create, economic growth and opportunities from a job creation and innovation perspective. Um, so I think I always believe the founders actually who choose the tougher path are very interesting and amazing, and something to choose to solve within this space, I think, is just amazing. What I feel. So to start off with, Ashish, again, you come from a pedigree of being from consulting to being with a venture capital firm to an entrepreneurship. I haven't seen many people. I've seen people trying to do that journey, but successfully trying to do that journey. I've seen a very few people doing that. And of course, looking at some of the exciting businesses that you see being with a venture capital, it's very tough to think that why you would choose something which is a very very tough business, right? So just let me start off with just asking you why off business and why B2B, right? There's so many exciting businesses where people you can just get visibility, you can get a lot of what you call star this thing, right, with the startups, with the commerce or anything else, which is, I would say, more sexier than anything else. So why off business and why B2B?
Firstly, thank you, Amsi, for having me here, and for everyone listening in. Will share my thoughts extremely candidly as I usually do. So please take it with a pinch of salt, especially when it sounds very extremist in nature. But with that caveat, why off business? I think when I was an entrepreneur, when I was a VC, I kind of two thoughts used to strike me. One thought was this thing that my destiny was not in my control. At the end of the day, the entrepreneur had to deliver, or the management teams had to deliver, and I had to kind of eat out of that outcome. And the second stuff was that the risk reward for being an entrepreneur, especially if you could make it happen, um, uh, it pretty much stacks up in the favor of an entrepreneur versus a VC, right? I'm a kind of a commercial guy. I've always been like that. And I kind of said, okay, what are some of the risks that I think are usual? One is obviously getting teams. I thought I was fairly good at it. A fairly good guy in terms of working in teams as well as in building teams. And the second thing was about, just having a good idea. And there was this thought in my mind that anything unsexy at the end of the day always makes money. And the third thing was about having the initial kind of fodder to begin with. And I was from that ecosystem, and I used to see a lot of people raising money at that time. And I said, okay, hey, you know what, I can be better than that. So those are the kind of two thoughts with those three sub thoughts which kind of converged in my head. And I said, okay, let me jump. I had a fling with doing a few ragtag businesses when I was a kid, and that thought always was in my at the back of my head that once I can take care of all my liabilities is the right timing. So the timing also seemed right. Having said that, why B2B? Fundamentally, when we started, B2C was the in thing. This is like um, early 2016, right? Consumer internet was on everyone's mind, and almost everybody kind of used to think about those problems that could be solved through technology, particularly from an internet standpoint. And I said, okay, if everybody's thinking about it, at the end of it, it's very tough to build a business, and if you build a business, it'll get copied very soon. So why not start it off in a space where nobody's kind of interested, where we have some kind of an exposure also to double up. So that's how B2B happened. B2B was the most unsexy thing to start off, the most unglamorous thing to think about. But I would say that not the common man doesn't really think about it. and that kind of made it happen for me. Also, I was a B2B guy, had invested in a few, had run a company while at ITC, which was a subsidiary, had traded between a few while growing up and stuff like that. So some experience also helped. Sorry for that long answer, but I thought I'll share the full thing.
No, I think we need long answers, and would love. I'm sure the audiences would love to hear you more than me. So, see, one of the things I always, Ashish, again, just coming from an entrepreneur background to the VC side, like as I was mentioning to you earlier, life throws a lot of choices for you, right? On taking up certain things, like you said, the risk to reward. Everyone sees that the rewards are huge when you get into entrepreneurship. I was a believer that everyone is an entrepreneur, but then I realized it is not true. There are certain traits of an entrepreneur which actually you kind of start feeling, right? So for folks who are looking at entrepreneurship, right, you know because they all get excited, like you said, they look at all the ecosystem around them, they see people around them, they see businesses around them, they see that, hey, you know what, I'll take this risk. I think I'll be a unicorn, whatever it is, right? Because there's so much going on, and everyone, of course, I think this year it's been subdued, but you've seen what happened. So what is your just a basic thought on how do you look at I feel that entrepreneurs have certain traits, right? You need to know yourself that, hey, you know what, I'm looking for these things within myself when I'm going out and starting a company, right? What are your thoughts on that?
Yeah, I will start off with the statement that everybody is entrepreneurial, but everybody entrepreneurial does not translate into an entrepreneur. An entrepreneur is very different from a guy who has entrepreneurial traits. So whenever people come and tell me, "Hey, I'm being an entrepreneur in my job," I tell him that, "Hey, it's all bullshit," because frankly, being an entrepreneur has many pluses and minuses to it. But let's begin with traits. I think the first fundamental trait is that you can kind of manage without resources, but because you can actually juggle up resources at will. That's the first trait. You're not going and complaining about stuff that I don't have time, I don't have money, I don't have the power, I don't have the bandwidth and stuff like that. You just generate stuff. You just generate resources. I think that's the first. Second is, I think, the ability to dream very, very big. I think entrepreneurs typically, at least in the new age era, when they start off, they have a very grand vision. Grand vision to really, change the world multiple times over, right? So that's the second one. I think the third thing that kind of brings an entrepreneur to life is to say that, hey, I have the guts and the perseverance. So and both have to go hand in hand. First of all, you need to have the guts that you can take biggies on, because every market that you go into has some kind of entrenched incumbent in whatever shape or form. So you need to have the guts to take them on. And second, when you will fail at a few steps in the beginning, which inevitably you will, you need to have the perseverance to actually last in that fight. So at a very high level, at a very philosophical level, if you've kind of displayed these three traits over and over and over again in your life, then I think you're ready to be an entrepreneur and ready to take the step. And then after that, kind of tactical stuffs follow that. But predominantly these three. One would be to summarize, would be the ability to generate resources. The second would be to dream extremely big. And the third would be to have a good combination of guts and perseverance.
Yeah, I think completely agree with you. And like you said, I think building the initial team when you don't have the money, right? I think that I've seen as one of the important things, because a lot of people think that you can, once I have the team, once I have the money, I'll have a dream team. But one of the traits I always see that people who are able to convince others, right, on the vision, and are able to kind of give them the sense that, hey, you know what, yes, we are building something big here, and able to bring the team, and high quality team up front, right? And it's very challenging, but that definitely goes to show the skill of how and what an entrepreneur is. So in your case, Ashish, would love to know your story about initial days. How did you go about building the team? What kind of people were you looking at? How did you convince them, right, that, hey, you know what, you need to be a part of this? Of course, a lot of us convince, but a lot of us fail also. So just want to understand how you went about doing this.
So first was selection and second was salesmanship. to convert on that selection. So let's take selection first. For selection, which was fairly a very simple process I'd followed, wherein I said that, hey, you know what, I want to take people who are fundamentally different from me because they excel in an area, in a soft or a hard area, where I today cannot do well. But at the same time, they share certain common values which are very dear to me, right? Or dear to the people who started off with. So those common shared values were, one, they were very hands-on to begin with. Second, they were very dhanda-like in their approach and not really, not knowing the value of money and stuff. And the third thing that we looked for is that people who are ready to actually lead unskilled to semi-skilled kind of people to begin with. Because I always believe that if you start the business with unskilled to semi-skilled people in terms of skill, you can actually make a large business. Otherwise, it's very easy to actually throw money and generate teams, right? So those were the three common values we looked for, and at the same time, being very different from who the initial team was some of the traits that we looked for. So one, very different, but three common values. Then how do you convert on that? Basic salesmanship. Salesmanship is about, in my opinion, starts off with saying that, hey, can you actually translate your vision into real tangible steps so that the other person on the other side of the table actually can see the vision, finds it exciting, and also finds it doable, right? Second thing is about convincing him without saying it openly on his face that, hey, you're a great guy. So if he rubs shoulders with a great guy, some amount of greatness will actually transfer to him as well, right? And the third thing, in my opinion, is to build that kind of a connect at a very basic human level, right? So people who have similar tastes to you, people who have similar hobbies, very tactical, but at the end of the day, people actually like that kind of, they want to gel with people who are similar, right? So hence we largely looked through our network. Most of the people here were very known to me. One was from my very basic household, right? My partner in both professional and personal life, which is Ruchi Kalra. Bhuvan was a close friend from previous days. Nitin, Vasant, again, same network. So that familiarity is important. Having that data point to say that, hey, I know the guy from before, and hence I can tailor my pitch and actually build my vision into reality in a way that he will understand, is something that we inherited with, right? So that's how we went about the story. Selection, and then salesmanship. Till today, I think, as you rightly pointed out, salesmanship pretty much stands out. We actually, I think we are good salesmen in general across the organization, because at every end, you have to sell a dream, whether it's to an employee, to an investor, to a lender, to a customer, a supplier, any ecosystem member. At the end of the day, if you can sell your dream, if you can sell what you're doing and tell them that, hey, this is something very exciting, then most people would like to associate themselves with, because they believe that, it's something great happening.
Right. And again, I think when people start off, the other thing is, of course, people have a lot of ideas, right? They just want to figure some people come with an idea and then start working. Some people start getting into entrepreneurship and figure out, which one to work on, right? Given the market opportunity and where it is and all that stuff. When you look at it also, now, B2B business, all that stuff, there's so many different variations in B2B business which you can look at, right? And what is it that you found exciting, right? And so let me just start off with saying, what are you really solving for today, right? And how have you simplified it, right? And what was the thought process in picking and choosing a particular vertical to solve for, and then actually moving on to the other verticals, right? So would love to understand the whole initiation. How do you pick one particular idea, right? And how do you go about building on top of it, right? Because the world is full of opportunities.
Right. So in my mind, it was fairly straightforward. So this is how we distilled it. We could have been in a software business, which could have either have been a service or a licensing software, or we could have been in a transactions business. Now, at a very high level, we said, okay, transactions make more sense. Why? Because if you look at the largest companies in the world, they are all built on the base of transactions. So we first zeroed out on transactions. Then we said, when we look at transactions, okay, there are three types of transactions that a typical B2B participant in the ecosystem kind of has. One is a commerce transaction. The second is a financing transaction, and the third is a marketing transaction, right? And when we because of our familiarity with how SMEs operate, we knew that these problems are interrelated. So if you take SMEs, because of our collective experience, we knew that SMEs get the raw end of the stick when it comes to commerce. Meaning that if you are looking at the SME space and saying that the real SMEs are the ones who are manufacturers or who are not intermediaries or retailers, but are manufacturers or infrastructure service providers, what you will get to see is that they are essentially working on doing one level of value add on a raw material. That raw material could be bulky in nature like steel, could be very feeble in nature like polymers, but they're doing one level of value add. But when you look at what happens in traditional commerce, they've been the ignored part of the lot, right? And as you rightly pointed out, they're the fat middle of the economy any which ways. How are they ignored? They don't have the right pricing transparency. They do not have all these new age tools when it comes to tracking and stuff. On time in full is ignored, all the standard commerce stuff. So there was one that end, which we knew from our collective experience is actually broken, because no new age guy was actually building solutions for them. Traditionally, solutions that had been built were mostly for larger companies or very micro companies where you could build a buck, but not really for the fat middle. The second was the financing transaction. And in my mind, the capital flow of transactions was largely going towards building of assets, whereas the real need of the SME world was working capital. Because working capitals, because SMEs were getting the raw end of the stick from both the supplier and the buyer, they were getting squeezed and more working capital was needed. And the working capital that was being provided to them was largely from the banks, which was woefully inadequate because it was around 25 to 30%. So essentially, they had to kind of rely on the intermediary economy, which was supplying raw materials for this working capital. So hence, the first and the second problem was actually interrelated. So commerce and financing was interrelated because that's how traditionally it was being served. The creditor on the balance sheet was the largest provider of the working capital, and at the same time used to double up as the supplier of raw material as well. Right. The third problem, which actually became a big window for us to entry into the ecosystem, was to say that, hey, you know what? Even if you solve these two problems together, the SME still will actually not get out of the rut that he or she is in today, because they are a prisoner of their own ecosystem when it comes to business development, meaning that they work with the same kind of customers over and over again. So they never discover newer quality of revenues as they go along. So in my mind, when we were thinking about SMEs, you have to obviously do good to your customer, and that's how you make money. That's how efficiency generates savings in the process, and you keep some part of it. Is how business models evolve, or at least are started off, right? And hence you had to solve all three together because of the kind of customer we had chosen or borrower we had chosen. We had to solve all three together to actually build a business. Now we started off with commerce because of our own familiarity with commerce. But we very soon added financing. In a couple of years, we added financing. But after having started commerce, we realized that the marketing problem also needs to be solved. Otherwise, you're not solving the entire full stack of the life of an SME. So we started with 1 and 3, then added 2 pretty much in some time. And frankly, how did we start with one vertical? Because we were exposed to it. I think commerce was really, really broken. It seemed the right thing to do. We could have begun with financing, but frankly, none of us actually were from a credit risk kind of a background, though we knew financing from a general knowledge standpoint. So hence, it was relatively easier to start with commerce. So we went in with what we knew, right? And within commerce, when we started, we built a simple marketplace of saying that, hey, we will just disintermediate, take out all the intermediaries, and actually take it from the source, the manufacturer, and give it off to the SME, who's the end user. Right. Within that, which all products did we pick? The products that we picked is the ones that we were again familiar with, and hence we found it relatively easy to start. So that's the kind of journey we went through. We said, okay, transactions first, but commerce, financing, and marketing put together. Financing seems like something we can't start off with because our incumbent knowledge was not high. But commerce and marketing is something that we needed to kind of start off our business with, which is what we started off with in 2016, February to June is when we started. So a little more than 7.5 years old in the journey.
And how do you see, I think one of the things is given, it is very unstructured and fragmented, technology intervention, I'm assuming is an important thing. And how important is it right now? And how is it, I would think it is more evolution than, you try to kind of disrupt it, right? I always think that, especially in this sector and B2B commerce, it's more of process integration, process definitions, and making sure the processes are set up in place, then actually bringing in more deep tech intervention as you go along, right? I might be completely wrong on that, but I would love to understand how you felt that technology intervention is very required here. What are the kind of interventions you actually said that I need to go with to start with, and work on it, right? So would love to get your thoughts on that.
So what you said is partially right. All those efficiency building measures of saying that, hey, we will have a great ERP, we will integrate with suppliers and buyers, we will make sure that the repeats happen through the technology, we will make sure that collections, if any, are triggered through the technology. We did, but that's part of the problem. We did not start off with that. We started off with something very, very fundamental. Because if you just are the former, then you are much more. I mean, tech is just one of the functions for you. For us, tech was critical because of one very simple thing. I mean, if you look at what technology today does, is that it builds access for you, right? It helps you reach out to a much larger set of users than what you could do in any other traditional forms of marketing or sales. So we actually used it for access. So how did we do that? We never used Google ads. We never used Facebook. We never used SEO. We never made SEM. We actually built our own Google. So how did we do that? So in the beginning, we realized that one of the key things in penetrating the SME unstructured ecosystem is the cost of acquiring a SME. And the moment you have a cost of acquisition attached to the SME, then you have to think LTV to CAC. And you will always fall off in that ratio, that there's a lifetime value, I'm spending this much, and hence you will die because of marketing. Anyways, Facebook ads and Google ads were costing a bomb to begin with. So we said, okay, let's find out a different approach of actually getting to this problem. How do we acquire at negative cost? Let's start making money while acquiring the customer. So hence, we came up with a very simple philosophy, which over a period of time actually has become quite robust for us, is that we said, if you look at our SMEs, they were manufacturers or infrastructure service providers. All of them had actually a government-oriented business, which means that they were bidding for tenders for maybe 20 to 30% of their business. It was either for government directly, or for an authority owned by the government, like National Highway Authority, for example, or a government-owned company like IOCL, ONGC, GAIL, Indian Oil, and stuff like that, right? So they were bidding for tenders. They were looking at these tenders, and these tenders system in India and globally is actually quite broken, because tenders are very voluminous. Close to 18 to 19,000 tenders get released in a single day, right? And they are very non-standardized as well. Meaning that a tender for, let's say, you are sitting in Bangalore, a Bangalore road versus a Delhi road, the same tender could be 80 pages in Bangalore versus 8 pages in Delhi. So imagine the plight of a SME sitting out there trying to figure out what tenders are relevant for him across thousands of websites and many other vernacular online platforms. We said, okay, let's build a solution, okay, which is a marketing solution per se, wherein what we tell the SME that, hey, you come in, you leave a lot of stuff about yourself. Like, for example, this is how big you are, this is the kind of tenders you look for. And then I go and crawl the internet space and find out tenders that are relevant for you and give it off to you. So then the SME has an incentive to leave more information about himself, which is how I'm giving him much more relevant data that he can use. And at the same time, I'm actually getting a lot of data which I can use for customer acquisition. So that's how we solved the marketing puzzle in the beginning. And the customers actually saw it as a marketing service, but it doubled up as a customer acquisition tool for us. And we were making money in the exchange because they were paying for subscriptions over a period of time. Now they pay for other transactions done on that platform. This platform is called Bid Assist. I mean, we have nothing to do with tenders, frankly. It's a pure technology product wherein we just filter and give them the probability of winning. We tell them that, hey, you know what? You can actually find other SMEs in the platform who can actually double up with you, and jointly you can bid for the same tender and stuff. But that's how we started a journey. We said, forget the efficiency for a minute. That's a necessity that almost everybody will do. We will do the same. It will enable you in underwriting. It will enable you in record keeping. It will enable you to keep your processes efficient. But beyond that, how do you start off with technology that gives you a real edge? And that's how we started off in the customer acquisition process. My fundamental belief is, unless you are leveraging technology to solve for access, anything else that you do is incremental to your business, right? And hence, for us, it is very critical, because it fundamentally was, I mean, till about 3 years back, it's not the case anymore. till about 3 years back, or practically 95% of our customer acquisition was happening through this platform. Right now, it's dropped to about 70% because we found out other ways, again, leveraging technology, allied technology, which kind of solves for the same problem. In my opinion, that's the only way and that's the only hack. Otherwise, the business, the SME business is actually quite unstructured. And if you want to reach out to him, because he's not in any technology, slowly changing, but very slowly, right? Unless you figure that out, I think you have a deep trouble in your hands because you will not make money quickly.
Fair enough. So, one of the things the founders have a lot of questions coming up. I'll just finish my stuff and then get to the audience's questions. But one of the things we always, when you look at people who are trying to raise capital, right? When we look at the other side, we always look at a founder quotient, which is very important, is that the ability for the founders to kind of go raise capital because it is required, right? And
Right.
you should have that as a skill, right?
Right.
Having said that, even convincing someone on one business model itself is tough. You were going after 1, 2, and 3. Of course, you started with one, and then you moved into other spaces. But what would your thoughts be in terms of when you look at, hey, what? How do I go raise capital? How do you tell the story? Because they always hear it from a venture capital standpoint, but we are the listeners, right? How, if you look from an entrepreneur standpoint, how do you tell a story which is so complex and make people believe, especially on B2B side, because not a whole bunch of people understand B2B properly, right? So what would you do? How would you do at every phase of the fundraise, right? And what are the things that you would achieve to make sure that you are you're able to successfully raise capital? So would just like to get your thoughts on capital raise per se.
Right. See, as a founder, you need to be very clear about what are you trying to tell, right? And when you are at your seed stage, so let's take 3 stages. Let's take seed stage when you have no business to show, and second we'll take the growth stage when you have some business to show, likely not close to being a very large business, and third is growth stage when you built a large profitable business and hopefully heading for the public markets in a couple of years, right? So let's take these 3 stages. At the first stage, the first thing that you need to know, I'm making it specific to B2B, otherwise it will become very generic, is because at the first stage, you need to know that most people coming in realize a few things about B2B. And the things that they realize on the pluses are that one, it's a large market, right? Second, they realize that, hey, you know what? A very unique solution for India will work for sure. On the negatives, they think that this is going to be a lower margin business. And on the negatives, they will think that penetration of technology will be tough. And on the negatives, they will think that working capital may be an issue. So anybody who's done a thesis around B2B will practically start off, and everybody does their homework before meeting you. So don't make the assumption that you have to coach people a lot. Everybody who meets you has done their homework, if not R&D, right? So they will start off with these 5 thoughts. You are a seed guy. So how do you really project yourself? So first of all, what you need to do is the following. You need to understand that you have to sell 2 things. One, you have to sell yourself, that you are a great guy. And second, you will have to tell that the market is a great market. Now, you are a great guy need not solve for the 5 things that we just spoke about. You are a great guy is a combination of very basic 3 things. One, you have a vision. 2, you are smart enough. And 3, you can build teams. Hopefully, fourth, if the investor is looking for it, hopefully fourth, that you are a little bit of a dhanda-like commercial kind of guy, because in B2B that those chops are important. So as long as you play to these 4 strengths, I'll repeat, as long as you can play to the 4 strengths, meaning you have a grand vision, 2, you have some kind of knowledge which is monetizable and looks business modelish, and third, you can build teams, and fourth, you can actually be commercial about how you, meaning that you can solve for less capital becoming more rewarding, or solve for profitability quickly. Those are the 4 things that makes you a great guy. So tailor your pitch around saying, hey, this is what I've done, and this is how it fits onto these 4 things. And it's a very basic 4-point questionnaire. I mean, these 4 points for sure exist. People may look for points 5, 6, and 7, but they definitely look for these 4. Okay. Now, when you go to the market, you should know that those 5 points that we spoke about in the beginning is exactly what is playing out in the investor's head. So when you are making your pitch, you should tell them how, obviously don't build on too much of the pluses because the pluses are already there. Tell them how do you plan to mitigate the three that they heard. So you heard about how we mitigated technology. You should have your own story about what you think you can do to make penetration of technology easier, right? For example, how do you solve for working capital? That problem you should have. So fundamentally know that the guy is coming in with R&D. Fundamentally know that he's coming for a great guy with questions around the market to be answered, and then tailor your pitch, right? So that's how I would do it at the seed stage, right? Now let's go to the growth stage. Now in the growth stage, they likely already know that you are a great guy because they've already put in money. Maybe a couple of rounds have happened. They already have done their research. They would like that feeling to be reinforced, but it's not a question in their head anymore. The question has now shifted, and maybe they know a little bit about the market also, given that you have some numbers to showcase. But now the question is around the business. So there is a question around the business, which is much more stronger in their head at the growth stage, at the early growth stage, post seed. There's a large question around the business. There is a smaller question about the market, particularly the future markets that you will get into. And there is a lesser question, maybe just needs around reinforcement, which is your own self. So that's how you have to tailor your pitch. If you're talking about too much of the fact that you're a great guy when you are in series C, D, B, C, D, nobody's going to hear you out because they already know that. Just reinforce that thought and move on, right? But when you move on to the market, talk a little bit about the markets, about how they will evolve and how you are going to continue. If you're going to continue in the same market, you believe that the depth is high, then reinforce that the economics that they see today will either get better or will evolve to a much better one as you go ahead. Or if you're going to get into deeper markets, talk about those markets and answer those 5 questions again that you heard in seed. So that's the second question, which is less around the market. Now, the third question, which is the real question, is the numbers. In my opinion, there are 3 things that an investor looks for when he looks at numbers in the growth stage. One is about the control that you have on these numbers, right? You may not have it as an individual, but you need to have it in the team that meets the investor, meets to the deliverer of capital. It could be a lender, it could be an investor as well. So one is control. You have to demonstrate that these numbers have happened because you've taken certain actions, which actually gives predictability that, hey, you know what? If he's going to charter his destiny going ahead, he has them in his own control. One, that. Second thing that you have to demonstrate, that these numbers will get better with time, right? Obviously, a historical trend helps, but a historical trend will continue into the future is always a challenge, that these numbers will get better with time because of whatever lever you want to use, right? The third thing that you have to demonstrate on your business is that these numbers are defensible with time. As they will become bigger, you've built certain things in your ecosystem or in your business, which actually will stand to the test of newer entrants coming in. Like, for example, think through the technology stuff that I told you. It takes time to build it, right? Today, we have more than 1.5 million SMEs who actually use it and are fairly active on it. So it takes time to get there, right? And by the time they get there, I would have built something else. Or by the time they get there, I would have so much data with me that it's defensible. So think about defensibility. I think those are the 3 things they look for in a business. One is control, because control basically gives them predictability and at the same time tells them how this business will be run in the future. Second is that these numbers will get better with time, right? And third, that these numbers are defensible, but meaning that as the numbers are being built out, a competitive advantage is being built in the business. So as long as you are aware that that's the question paper, you will deliver to it. What people do, and I've seen a lot of them because I've invested in a few as well, and also quite an active guy in the community, is that people lose sense of what questions are being asked. When you are sitting with an investor or when you're in the process of diligence, you should very well know what you are being asked or being evaluated for. As long as you're doing that, you can actually weave a story around it, right? Now, coming to the third one, then then the person doesn't matter at all. This is when you're like a couple of years away from an IPO, which is the stage I'm in right now, maybe a year away from an IPO, right? There, the person doesn't matter. The markets don't matter. What matters is business. And with business, they look at only those three questions again. The first two have just disappeared, right? So that's my sense. I think just using the using the lens of saying that, hey, I'm being evaluated for these, and having these questions very clearly articulated is the way to raise money. That's how we've done it so far. And some results are in front of you. Obviously, we can get better. It's the start of time. So, but yeah.
No, I think the results have been great. Everyone agrees that so far. I'll take a few questions here, Ashish. There's one question from Manas Mohapatra. The question is, how did you crack the financing issues of SMEs? And how did you gain trust and got rid of the middle layers in procurement? Didn't you get a huge resistance from unions, etc.? So,
yeah. So how did we crack the financing? Has two embedded questions within it, right? The first question is, how did we first learn financing? Because most of us were not from a credit background. And even till date, I'm the CRO of the company, right? Of both companies put together. CRO is Chief Risk Officer, the person responsible for the credit risk and the asset quality thereof. And the second is, what kind of gap did we foresee and how did we build a solution there? Because remember, at the heart of it, financing is a commodity. So unless you figured out a niche in the market wherein you can tailor your solution around it, right? You can never really succeed. So let's take those two embedded questions separately. The first question is, how did we learn financing? I'll tell you one very simple thing: just burning the midnight oil. We knew that because financing is a commodity, there is so much stuff to read about, there is so much stuff out there, and there are so many people to speak to. We just, I would say, over a 6 to 12 month kind of period, we just learned credit risk and how the ways that they are evaluated in India and at least in similar markets very, very quickly. We just burned the midnight oil. Very simple. We looked at risk policies. We looked at what people do. Typically, when it comes to underwriting behavior, we spoke to like hundreds of people, and we figured that out. That hey, you know what? One is not very different from the other, and we don't need to be very different. Obviously, we'll have to do stuff differently, but the stuff that needs to be really evaluated is not very different, right? So we'll come back to what we did differently, but we learned the things around how underwriting is done or how risk evaluation is done very, very quickly through that method. Now, how did we tailor a solution? So for us, the SME opportunity was fairly straightforward. SMEs were not really growing leaps and bounds, which means that the capital needed for asset building less, right? So hence the biggest solution that they were looking for was working capital. When you looked at working capital, 25 to 30% was being provided for by banks because of two very simple reasons. One, they net out the trade credit or the credit that the SME can get from the intermediaries or the suppliers of raw material. And at the end of it, they also look for hard collateral which will serve them as a cover for working capital. Most SMEs don't have both, and hence banks tend to be 25 to 30% of what the working capital need is. For a good SME, it could be as low as 15% as well. So hence they are reliant more on the intermediary economy. So the first thing that we positioned ourselves as, we said, hey, you know what, we will not replace the banks on your balance sheet. We are not competing with the banks. They will be the cheapest. And the moment they increase the exposures to you, you should be cutting out into either trade credit or into us. But the ones that we will replace are the intermediaries on the balance sheet. The intermediaries are the trade creditors. It's the trades payable. It's the creditors, right? And the way we designed the solution is we said, okay, this is how you deal with creditors today when it comes to working capital. We will just take that solution, embed it with technology, push in more institutional capital that is cheaper, and we'll make it cheaper for you as well. And we'll make it exactly the same manner in which you deal with them. You'll deal with us as well. So we took up the traditional intermediary economy and made it much more efficient and cheap. That's how we did it. So if you look at a trader, the way he deals with the SMEs, that he says, hey, you know what, I will give this limit. I'll never go more than that in terms of exposure. We did exactly the same. The way trader deals with it is that he has an exposure. At the end of it, if some part of that exposure is used, then the limit opens up again. You can buy again. We did exactly the same, right? So we just copied the exact way of behavior, but we started doing things efficiently because of technology and institutional capital in, and hence we passed off that benefit of cost. So that's how we solved for the problem of the SME, and we were different in delivering that commodity, which is financing, right? Now, the underwriting is a separate question. Unless there is a separate question, I don't want to extend the monologue, so we'll take more questions maybe.
Sure. I'll take a few questions. This from Hitesh. How does OfBusiness look at the segment where manufacturers of consumer goods want to sell to retail in India, given a lot of PLIs for manufacturing consumer goods in India?
Early days, very early days. I think consumer goods is a difficult segment. Um, at the outset, it actually seems as if they are making a lot of money. But frankly, this is the most consolidated, the most lucrative segment, which actually the corporates have gone a lot into. So my sense is that it is going to take a lot of capital to build it out, because not only do you have to build capacity so that you are cheap and your fixed costs are amortized over a larger base, but you need to have a lot of marketing muscle, in the beginning, and that will make businesses capital inefficient, and the capital intensity will be very high. So that's one. So you should know, if you're a guy, if you're a entrepreneur building out in that space, that hey, you have to solve for both capital intensity as well as capital efficiency. I think both of them are a problem in the consumer goods space. So those are two. I think the second problem, I'll give you the pluses as well. The second problem that I foresee in that is that this is a model wherein it is very difficult to build something very defensive. Predominantly because almost everything comes out in the open, and most smart guys are thinking about it, and smart guys can see it. So to build something which is very defensible will take time. It will take inordinate amount of iterations before you actually land up on something which is very defensible. On the plus side of it, obviously the margins are better, right? On the plus side of it, businesses can be capital efficient on working capital, though you may tend to lose a lot more money because of marketing in the beginning. So you have to kind of understand these two negatives, and not really dwell on the positives. I think a lot of people jump into the consumer goods space just assuming that the two positives just outweigh the negatives. In my opinion, they don't.
And given that, Ashish, you're looking at going public, and some of the key elements anyone would look at is, how and what are the levers for growing the margins, right? So again, like when we initially discussed, everyone thinks it's a low margin business. You need to have a lot of captivated businesses over there. What is the kind of larger TAM here? How are you going to improve the margins? So what are your thoughts, especially on the B2B? Because you start with very thin margins. Obviously, we spoke about the ability to constantly raise capital, look at different verticals where you can actually integrate finance as a part of your core business, try to look at all these verticals, right? So how would you look from here as to what are the levers I would touch on to say that yes, there is margins in the business, there is growth potential in the business, both from a top line and a bottom line perspective. So how do you see in your business margins improving, and from where?
Right. See, if you look at B2B like any other business, it has 5 levers of making money. The first obvious lever is aggregation, which is distribution, trading, supplier discounts, or value built out of discovery and stuff like that. So just pure, aggregation margins. The second margins are the manufacturing margins. The person who manufactures it obviously keeps a chunk of it. The third margin is the financing margin. The person who actually takes the capital risk on his balance sheet and is also exposed to a lot of capital being deployed is the one that makes money. So that's the financing margin. The fourth is the servicing margin. For example, somebody is doing warehousing, somebody is doing logistics. It could be other stuff like quality testing and stuff like that. So that's the fourth margin, which is the services margin. And the fifth margin is the marketing margin or the brand margin. The margin you command a premium because you are a brand, right? When you're building a business, and I'm hoping that most of us are early entrepreneurs, okay, you have to cut out the fifth. You will never make money from the fifth. It's very simple and straightforward. You have to make money from the first four, right? The way I have thought about the problem is to say that, hey, service margin is very difficult, because essentially service margin tends to be out of three such services, three very basic services in B2B commerce. One is logistics, the second is warehousing, and the third is quality testing. My problem with all three is that, at a very philosophical level, all of them actually happen in the night. The trucking happens in the night. The warehousing has to be, I mean, obviously, you don't need to guard too much in the day. You have to guard it in the night. And when the material is being shipped, it's typically night after the no entry, and hence you have to do quality testing in the night. So if you're working in the night, you'll be irritable in the day. So maybe what you're making in the day is what you lose out. So hence, I don't like servicing margin. Some people can make money out of it. So essentially, I'm left with three: the aggregation margin, which, as you rightly pointed out, is thin, but we'll come back to it. The second is the financing margin, and the third is the manufacturing margin. Now, aggregation margin, though on the looks of it actually looks very thin, it is not very thin. The reason being, you can easily, I mean, when we were a pure aggregator without any financing, we were easily making about 5 to 6% gross margin and about 3 to 4% EBITDA, right? And making about 2 to 2.5% of PAT. But the beauty of it, what we delivered towards, which one everybody should aspire to get to, and all the good guys get there, is that the working capital deployment was less than a month. So it was about 20 to 25 days. So you are essentially turning the capital many times over. You're turning the capital 12 to 14 times a year. So 12 to 14 times you're making 2% PAT. Still, that's about 25, 30% return on capital, which is a brilliant business. So as long as you are delivering a quicker turn while being 2 to 3% PAT, it still makes sense. But that's aggregation margin for you. But even if you do 2 to 3% at 12 times or more, people will still tell you are a thinner margin business. So how do you increase your margin? In my opinion, you have to first take a call between either manufacturing or financing after you start doing aggregation. The way to think about it is, the difference between the two is manufacturing is a very different DNA. It is the DNA of trying to marry money, material, and labor, or man. Money, material, man. Yeah, that sounds better. So if you have the ability to actually manage money, material, and man, which you're not doing in aggregation, then it's better to take the manufacturing step first, because you have to eat into the manufacturing margin. Manufacturing margin, though, doesn't turn as much as the aggregations. So if the capital was turning 12 times there, here it will likely turn 10 times, right? But the thing is that you can actually get a lot of margin. You can, if you there you were operating at a 6% gross margin, here you can easily expand to about 10 to 12. But your DNA has to be that you can marry, and that's another M, marry man, material, and the machine. Not many people can. It's a very different DNA. The trade-off is that if you are going for financing, there you have to marry capital raising, particularly debt, underwriting, and collections, which are very different skills again. So after starting off with aggregation, you have to take a step to say, hey, will I get towards the servicing side? In our case, we did. So you're left with manufacturing and financing. They're very different DNAs. So whatever your DNA is the one that you have to get to. But in my opinion, a good business, a good aggregation business is one that is 6% gross margin, 2% PAT, 3 to 3.5% EBITDA, but turning 12 or more times in a year. A good manufacturing business built on top of an aggregation business is a 10 to 12% gross margin business, 4 to 5% PAT, but still turning 10 times a year. Right? So then essentially you're showing path to building out on a portfolio basis about 30% ROCE, which is great. Or a good aggregation business built out on top of a financing business essentially tells you that you can actually build two different businesses and solve for two different needs and two different businesses which cannot be quantified together. But the profit pool that you eat into financing is very high, and hence the sum of the parts will actually look very brilliant. So that's the kind of stuff that you have to think about. 5 value pools. 5th value pool, if you're thinking about in the beginning, doesn't make sense. Take your call around the first, the second, the third, and the fourth, having built the B2B marketplace. I hope I made sense to.
No, I think it's a lot of sense actually. And, one question I had is, just from again coming back to the entrepreneurs stuff, when you kind of look at businesses and say, hey, you know what, I need to do pivots, right? And did you do any pivots during the business? You know, it seems like this is a pretty structured story when I listen to you, but
Because I'm a good
where
sales guy, remember?
I
That's what I
know
said
that.
in the beginning.
That's what I could see. But I'm just saying, obviously, when people go through, their own journeys, they see that certain points, they just keep going, right? Because they're checking along, they believe in it so much. They really don't care for a lot of what you call validation from the external side, right? But pivots, I feel, are very important. I mean, for someone who's starting, if they don't feel that product market fit is there, or the market is not evolving to the way they would look or expect it to grow. Have you come across those instances? When do you think you need to really think about pivots? And some pivots are very, I would say, more aligned towards your goal, but some pivots might be very drastically different, right? So would like to get your thoughts on that, Ashish.
Yeah. So pivots are essential. The reason pivots are essential is because if you're trying 100 things when you're an entrepreneur, you will likely get 2 or 3 correct. But those 2 or 3 essentially, like in investing, have to pay multiple times over what you lost out in the other 97 or 98, right? So you have to continuously pivot. The way I think about pivoting, though, is that what are you pivoting? Like, for example, in the stuff that we were speaking about in the very previous conversation, was saying that should I get into manufacturing or should I get into financing? Fundamentally, if you take pivot as a definition of saying I'll stop the former and begin the latter.
Yeah.
Okay. If you get that kind of a level wrong, which is that you've got into financing and then you say, hey, financing is not working for me, let me get into manufacturing. Or you say, hey, you know what, financing and manufacturing are not working for me, I'm getting into servicing. So if you have to pivot at that level, then according to me, you're not smart enough. You're not the good dhanda guy. But within financing, you say, hey, you know what, I started off with this product, this financial product, this is not taking off that well. Let me just kind of stop this product and start a different product with my learnings in that particular product. It's okay. If you started manufacturing in a particular space and you say, hey, you know what, I started off with manufacturing at this product that didn't really take off, let me just kind of do one level of value add. It's okay. In my opinion, there are big questions and then there are steps to be taken so that you get that big questions answer for yourself right. If the pivot is happening at a top level, which is at the questions level, like really strategic level, then you have a problem because you will burn money, and more importantly, you will burn aspirations, and more importantly than burning money and aspirations, you will burn time.
Yeah.
So once you pivot at that bigger level, you have a problem on your hand. But at the level below, you have to continuously pivot. And I'll give you a tip around continuously pivoting. The right way to pivot at the next level is to completely pivot. If you think you have done something wrong, just shut it down. Just shut it down immediately. Even if you have to pay money for it, even if you have to burn money or burn bandwidth to actually shut it down, just do it. Pivot completely at that bottom layer. But when you're doing it at the top layer, you cannot pivot completely any which ways, and hence the cost of that is very, very high.
Yeah. There's one more question from Preetham. So the question is, manufacturing of B2B products like paper, raw material of paper mill gives instant cash money, and by selling side, buyer needs 40 to 45 days on the sell side, right? How do you solve that gap?
So there are very many ways. See, this gap has been solved for in in traditional ways. So you need to first understand what is being done, so that you don't do something very, very different, and then you start thinking about how to do differently. The way it is being done in the traditional economy is that if you see a 45-day cycle, either you have the ability to absorb it because you have a financing ecosystem that can take care of it, like a bill discounting system, a purchase bill discounting system, and stuff like that, or you get somebody who's a financier, typically the intermediary that we spoke about, the trader. So you first need to know whether you need to do it yourself or you need to outsource that problem. In my opinion, what I have seen is that if you are relying on an intermediary to solve that problem for you, you become a prisoner of his risk appetite for your own growth. So you have to solve the problem yourself. Now, if you have to solve the problem yourself, there are 3 ways of solving it, at least in the traditional economy. One way is you give it off your own balance sheet. You raise your capital at a much cheaper rate. Like for example, our working capital today comes in at about 7.5%, whereas I make about 2%. I'm giving it out, but these are per 7% was annual, 2% is per month. So I make a clean arbitrage of 11 to 13% annual in terms of the capital that I'm deploying. And as long as I can manage both my cost of collections as well as my cost of servicing that customer within this 11 to 13% in terms of the capital that I'm deploying, I'm profitable. So that could be one method. A lot of people do that, especially I would say the small and the medium SMEs have kind of done that. The second way to do that, again, has happened in the traditional economy when you're solving it on your own, is that you get bank financing to do it on a bill discounting, right? Um, Good and bad. There are pros and cons. I'm not a big fan of it because, frankly, I think the customer is mine, and at the end of the day, if you are getting an external financier to partake that margin from you, I mean, for me, once I've acquired the customer, the entire margin should be mine, and to partake with that margin because I can't do some stuff doesn't sound great to me. But I think people are built differently as well. But that's the second way in which it is solved. The third way in which it is solved is that you actually tell the financier to finance your customer, right? And you become what is called a purchase bill discount, meaning he uses that line to buy stuff from you, right? All the big wigs do that. They give working capital lines to their own. They don't take working capital lines on their own, but they give working capital lines to their customer, and those lines are actually exclusive to buying from you, right? If you can pull that off, that sounds like the best of both worlds. But fundamentally, it is a function of scale and stage, and it's a function of credit rating. I mean, I would say, look at our credit rating A plus, but I don't think we've kind of pulled that off here as well. So it takes time to get to the third. So once you know these three things, build your own solution. But you need to know these three things.
That's great. I think before we go, I think we're running short of time. I have a lot of questions, which maybe I'll try to consolidate and send it across to you, and then maybe we can actually get back to them if possible. Just one last question. Given that culture becomes such an important aspect of any team, right, and any company basically, and especially given that of course the way we think about B2B being boring, what do you do to keep the culture like really interesting and fun at your place?
Yeah, I think more than fun, it has to be satisfying.
Yeah.
Right. I think as long as satisfying is solved for, the fun gets taken care of on its own. And I'll tell you what in my mind is satisfying. Fundamentally, satisfaction for anybody who's associated with you, okay, like we call an OFBN, gets satisfied because of three things. One is money, second is fame, and the third is power, right? And the way to think about this is if they are making more money than they used to at a very tangible level, they'll be satisfied, right? Similarly, if they gain power as they go along in their journeys and gain it quicker than what they think they can get elsewhere, they're satisfied. And the third is about being famous, right? If they're more spoken about, they get a pat on the back, and so that's how we try to solve it. We say that, hey, you know what? Let's deliver on these three counts. And the right way to deliver is you make certain promises. You deliver on these three counts beyond the promises that you've already given them, and they stick to you. So that's how we think about culture. One of the other choices that we've made about culture is that we predominantly, the median age of OfBusiness and Oxizo, the two companies that we run, is close to about, my sense, between 24 to 25, right? So we predominantly have very young guys. A lot of them are freshers. A lot of them are 0 to 3 years of experience when they join us, and they've pretty much built their careers here. So hence they buy into the philosophy a lot better. So that's the second element of culture that we've kind of, always worked towards. The third is about leading by example. So if I'm doing, if I'm saying something, if I do it, then I think the guy below me is going to do the same, right? So leading by example when it comes to culture is the third element that we all try to follow in all walks of life.
No, I think this has been great, Ashish. I feel like I want to have a conversation for the next couple of hours also. There's so much to learn. I'm sure the audiences have really, enjoyed this session. And I thoroughly enjoyed and learned a lot from this session. So it's been great. Thank you a lot, Ashish, and for sharing your views, thoughts, and, wish you all the very best with your IPO.
Thank you so much. Need all the luck.
You take care,
Thank you for
Ashish,
listening.
and have a good
Thanks
evening.
for having me.
Thank you, everyone, for joining. Thank you.
Thanks everyone for joining.
Bye bye.
Bye.